Corporate finance practice problem using Excel. Capital lease versus operating lease balance sheet impact. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side. What we have here is our starting point balance sheet, and then we have our capital lease information down below. The starting point balance sheet doesn't have the capital lease information. Then we're going to include the capital lease and look at the change or the impact on the balance sheet, and then we'll take a look at some of our ratios that could be affected, including the debt to asset ratio and the debt to equity ratio. And this, of course, giving us an idea as to why it might be important to include the capital lease, or give us some justifications or some rationale as to, why there are some rules with regards to the reporting of the leases as either a capital lease or as an operating lease. Because remember, the idea of this would be that if a lease is set up in the form of a lease, even though in actuality it's more of a purchase that took place, then it should be on the books basically as kind of a purchase, which reflects what actually happened, or closer to what actually happened, even though in form it's going to be in the form of a lease. That's going to be the idea of it. Note, however, that there's also footnote requirements as well. So you could argue that, if there's appropriate footnotes with regards to lease obligations, that a market that's going to be an intelligent market that looks into the detail in the footnotes would also be able to pick that information up there as well. So you can argue back and forth in terms of, how much regulation is needed. Do you need to put it on the balance sheet or not? How much needs to be on the footnotes versus the balance sheet? But those are the general concepts. So we have the balance sheet here, our starting point, where we'd have our kind of a pretty straightforward balance sheet just to look at these differences. The current assets at the $70,000, property, plant, and equipment at the $55,000 for a total $125,000. Current liabilities $11,000, long-term liabilities $42,000 for a total of $53,000. Equities at $72,000, liabilities and equity then at the $125,000, which of course matches up to the assets at the $125,000. Then we have the leases that are determined to be capital leases, which are not on the balance sheet at this point in time, and which we may have to include then, is going to be the $28,000 annual payments, discount rate of 13%, years at the 30 years. So if we were to record this as a capital lease, then we would have to take those annual payments and think about what the present value of those payments are, and record the asset and the related liability as if we basically purchased and financed this piece of equipment. So let's go back up top and do that. We'll do our calculation. This is a present value of lease payments, let's call it. Lease payments, present value of lease payments, and then negative present value, shift 9, picking up the rate, which is going to be that discount rate of the 13%, comma, number of periods we just said was 30 on the periods, comma, and then, so this is where we're at. We have the rate, periods, and now we have the payment, which we said was the annual payment. Notice it is annual here, so we're picking up the annual payment of $28,000. If it was monthly, of course, you'd have to take into consideration, the difference between the monthly and annual and so on. That's going to give us the $209,878 about that we would then have to be including in the balance sheet. So now let's say, well, how would that look on the balance sheet? Well, we'll still have the current assets. I'm just going to pull over the current assets. Those are the same. We've got the property, plant, and equipment. That's going to be the same, the PP&E. But then we also have this leased asset, right? So now we got the asset on the books, the leased property under the capital lease, and that's going to be equal to, which is determined to be the $209,878. Going to underline that font group and underline it. That's going to be our total assets. And let's sum that up, equals the SUM, adding those up. Then we have the current liabilities. They're going to be the same on the current liabilities. We got the long-term liabilities. They're going to be the same. And then we have this obligation under the capital lease, which would be kind of like, as if we financed it, right? And so we got that's going to be the $209,878 as well. So notice it's on the books as an asset and liability, which makes you might then say, well, what's the point? Because the accounting equation is basically going to come out to the same point but we're going to have an increase in the assets and liabilities. In other words, we had an increase from the terms of the accounting equation on the asset side of things and on the liability side of things. So we're going to then sum this up, summing up over here, and that's going to give us our total. Let's call it total liabilities. Let's actually bring that in from this side. Total liabilities. So there we have that. And then we've got our equity down here. So I'm just going to call it the equity, which is going to be, and I'm going to calculate this as the assets minus the liabilities, would then be the equity at the 72,000, and then the total liabilities and equity would then be equal to the sum of the liabilities and the equity. So that gives us our 334,878 liabilities and equity matching up with the assets up here. So that looks like we are in balance. Let's put some double underlines in there just to emphasize the bottom line of our balance sheets. Okay, so what happened then? Of course, on the accounting equation, we've got assets went up by the amount of the capital lease, and then liabilities also went up. So what's the big deal? Not a big deal. You might think, because we're basically at the same bottom line in terms of the net assets or the equity, as you can see here. But obviously, when you look at ratio analysis, you could have some impact in terms of the ratio analysis calculations with regards to this, because although we're at the same equity standpoint, net assets minus liabilities, we have more on the assets and more on the liabilities. So if we look at some ratios, such as the debt to asset ratio, which is a common type of ratio. So the debt, we're going to say, is the liabilities. This is what it was before. We were at the debt of the 53,000, and then we had compared to the assets, which before was at the 125,000, which gives us a debt to asset ratio of equal 53,000 divided by the 125, making that a percent numbers group, percentifying it a couple decimals. And then after, we had a debt of the 262,878, and we had the assets of the 334,878. And if we divide that out and make that a percent, we got the numbers group percentifying that, add a couple decimals, we're at the 7850. So you can see basically a substantial difference to the debt to asset ratio. Let's put some underline here, font group and underline. And then we can take a look at the debt to equity ratio. So if we take the debt is, once again, before the debt was the 53,000 and equity was equal to the 72,000. And so that gives us our debt to equity ratio, which is equal to the 53 divided by the 72. We were at a debt to equity numbers group, making that a percent, couple decimals, 73.61, underlining that. And now we have a debt after this whole thing of the 262,878 compared to the equity of the 72,000, underlining that, font group and underlining it, dividing it out. 262,878 divided by 72,000, making that a percent numbers group, percentifying a couple decimals there, of the 365,011, right? So we have, of course, a substantial difference with regards to the debt to equity, because once again, the equity is going to be the same, but we increased the debt levels. So that gives you some justification that this should be apparent somewhere, obviously, right? If there's an obligation in form that is, then we need to know what those obligations are. There's still kind of argument as to, how transparent, where it needs to be, because you could say, well, look, if you list out all the leases that you have and put the lease obligations in the footnotes, then a sophisticated investor would have access to them and should be able to basically work this type of analysis out between the two obligations anyways. But it might be more transparent, of course. The argument as to why it should be on the books as a capital lease and not simply a footnote would be, well, we want it to be as transparent as possible. We want to make sure that it's on basically the face of the financial statements and possibly make that more clear. So again, there's always debates as to what should it be in terms of the standards, how much reporting, or what should the reporting look like. But you can get the idea of what the impact could be under these types of obligations, and that it should possibly be put somewhere, possibly on the balance sheet and footnotes, or at least on the footnotes, and so that the investors, have that transparent, or have the information they need to make the decisions they are going to make